Hi everyone, my name is Talib Tings, and today I'm going to share about the analysis for the financial performance of 12 US companies over the past 5 years. Basically, we want to understand how these companies have performed in terms of risk and return. We look at the monthly stock returns from January 2019 to December 2023. And we use some well-known financial models to dig deeper. Our goal is to give you insight into which stock might be good pick based on their history performance. Plus, we will see how simple $1 investment would have grown in each of these stocks over time. So let us go to the next part. Okay, so let's talk about how we do this. We collect the monthly stock return data from these 12 companies, including the dividends for the last 5 years, and we got the market returns and the risk-free rate data from the Pharma French website, which is reliable. After getting all this data, we clean it up and organize it in the Excel workbook. So, for the part A is risk and return analysis. We calculate the annual average return and return volatility for each stock. We separate the risk into the systematic risk that is related to the market factors and the unsystematic risk, which is specified to individual company. To illustrate this, we plotted a return risk graph show the annual average return against volatilities for each stock, the market portfolios, and the risk asset. And the next part is the CAPM beta estimations. We estimate the CAPM beta from each stock by repressing the asset stock returns against the asset market returns. This allows them to measure each stock sensitivity to market movement. We also calculate alpha, which indicate a stock performance on risk-adjusted basis. We plot this finding on returns beta graph, including the security market line (SML) to visualize the relationship between returns and beta. And the next part is part C, which is Pharma 3 factors model. We apply the Pharma French 3 factors model to further understand this risk and return characteristic. These involve regressive stock returns against 3 factors: the market returns, SMB, which is small minus big, and HML, high minus low. We calculate the beta and alpha for each stock, providing a deeper insight into the factor driving the stock performance. And the next part, part D, is investing growth stimulation. We stimulate the growth of $1 investment from January 2019 to December 2023. We calculate the growth by multiplying the initial investment by 1 plus money returns for each subsequent month. Then we visualize this result in a growth graph showing how this investment would have grown over time for each stock. And the last but not least, part E, the perfect foresight investment. We aim to stimulate the theoretical maximum growth of a $1 investment under the assumption of perfect foresight. For each month, we identify the stock with the highest returns among the 12 selected company and relocated our one's investment to that stock. By calculating the monthly returns for this top performing stock, we determine the cumulative growth of our $1 investment over the entire period from January 2019 to December 2023. And the result was shown in a growth graph and demonstrating the potential impact of perfect market market foresight. So let's jump into the part A. We look at the risk and return characteristics of our 12 companies. First, we calculate the average returns by taking the monthly returns and scaling them into the annual figure. And this gives us an idea of how much each stock returns on average per year. And next, we calculate the annual return volatility, which tells us how much the stock return vary from the average. The higher volatility means higher risk because the returns more spread out. We also spread the risk into two parts: the systematic risk, which is the risk associated with the overall market, and the unsystematic risk, which is unique to each company. This helps us understand whether the stock risk is due to market conditions or company-specific issues. And to make it easier to understand, we plotted these returns and volatility into a graph. So from this graph, we saw that NVIDIA had the highest annual average returns, but this also and higher volatility meaning it's quite risky. On the other hand, the company like IBM and Johnson and Johnson has more stable returns with the lower volatility, which is a great for those who prefer less risk. So all in all, the part A gives us clear picture of how each stock performance in terms of risk and return. It helps us to see which stock are higher risk, higher reward, and which one is safe bet.
Hi, my name is Steven, and today I'll be talking about the second part of our assignment. In the second part of our analysis, we estimated the CAPM capital asset pricing model beta for each of the 12 selected US companies. The CAPM beta measures how sensitive a stock's returns are to the market's movements. We also calculated this by regressing the excess returns of each stock against the excess market returns. The beta indicates the stock's volatility relative to the market. A beta greater than 1 indicates higher volatility, while a beta less than 1 indicates lower volatility. Additionally, we calculated the alpha, which measures the stock performance on a risk-adjusted basis. Positive alpha indicates outperformance, while negative alpha suggests underperformance. We also visualize the relationship between returns and beta by plotting a return beta graph, displaying the average annual return on the vertical axis and the CAPM beta on the horizontal axis, including the security market line, also known as the SML line. Our findings show that high beta stocks such as NVIDIA and Microsoft offered high potential returns but with greater risk, while low beta stocks such as IBM and Johnson & Johnson provided more stable returns with less risk. This analysis helps investors to understand the risk-return trade-off for informed investment decisions. In the third part of our analysis, we applied the Pharma Friends three-factor model to understand the risk and return characteristics of the 12 selected US companies. This model includes the market return, S&P, and the HML factors. We regress the excess returns of each stock against the market, S&P, and HML factors to obtain the three beta coefficients. Market beta, which explains the sensitivity to the overall market returns. S&P beta, which explains the sensitivity to the size premiums indicating performance differences between the small cap and large cap stocks. And HML beta, which explains the sensitivity to the value premium indicating performances difference between the high and low book-to-market value stocks. We also calculated alpha, representing the stock's performance on a risk-adjusted basis after considering the three factors. Our analysis revealed several key insights. Number one is that the market beta for NVIDIA and Microsoft had high market betas, indicating high sensitivity to market movements and potential for higher return volatility. For S&P beta, some companies, especially the smaller tech firms, had positive S&P betas, benefiting from the size premium when small cap stocks outperformed. For a third factor, HML beta, companies like Johnson & Johnson had positive HML betas, showing that sensitivity to value stocks and performing well when value stocks outperformed growth stocks. For our fourth and final factor, positive alpha values for stocks such as Nvidia indicated outperformance on a risk-adjusted basis, while negative alpha values indicated underperformance. This analysis would then help investors understand the factors driving stock returns and make sure more informed decisions based on their investment goals and risk tolerance. Thank you.
In Part D, we examine how a $1 investment in each of the 12 selected US companies would have grown from January 2019 to December 2023. Nvidia achieved the highest growth, demonstrating strong performance. Microsoft also showed strong growth due to its solid market position. In contrast, IBM and Johnson & Johnson provided stable, moderate growth, which is appealing to investors who prefer lower risk. This analysis helps illustrate the trade-off between high return and stability, guiding investors in balancing growth potential with risk. In Part E, we explore a hypothetical scenario with perfect foresight, where we assume the ability to invest in the best performing stocks each month from January 2019 to December 2023. With this approach, an initial $1 investment could have grown from $1 to $12,570 over the 60 months. This illustrates the extraordinary potential of consistently choosing the top performing stock each month. In comparison, investing in Nvidia alone would have grown to approximately $14. This shows the significant difference that perfect investment could make. This emphasizes the value of historical data for optimizing investment returns, even though perfect foresight remains a theoretical concept. Throughout this research, we gathered and analyzed data from 12 US companies, performing calculations to evaluate various factors such as volatility, growth, CAPM, and pharma French results. Our analysis provided insights into the performance of different stocks and demonstrated that selecting the best performing stocks each month could have significantly enhanced investment returns. The findings underscore the value of using comprehensive data analysis to understand risk and return dynamics, optimizing investment strategies, and make informed decisions based on historical performance. Thank you.